Okay, well, judging by the equity rally yesterday, hope reigns over despair this coming year. But Morgan Stanley Asia Chairman Stephen Roach says there are 4 reasons to remain skeptical about a global recovery. And Stephen's here with us now and has outlined those reasons in a Bloomberg column. And Stephen, great for you to drop by during your break. Yeah. Okay, so I was reading through your column, the 4 reasons. I want to start off with the one that I think is very compelling, which is that we still have almost $2 trillion in assets, I believe, that we haven't written down yet, toxic assets, and that's going to crimp the bank earnings going forward, right? We haven't talked about that.
Look, these crises do not end overnight, especially one of the magnitude that we went through in late '08 and early '09. We have seen a lot of write-downs, but financial institutions are, I think, still reluctant to take the full extent of those write-downs, and so their earnings will be impaired, as will their ability to intermediate credit into the real side of the global economy. And that's a tough headwind, and there are plenty of others, especially what I think is going to be a multi-year retrenchment of the overly indebted American consumer, and there really aren't any consumers of the scale and scope that can offset the U.S. consumer. So the global economy remains vulnerable, in my view, despite all the euphoria that you correctly point out that's in the markets right now.
Right, and you say, in fact, that there's a 40% chance of a double dip in the U.S. here or elsewhere?
U.S., globally, this is not rocket science, but it certainly, the 40% probability I assigned to that outcome is assigned simply to indicate this is a much more significant possibility than the average investor is willing to concede.
Stephen, the World Economic Forum in Davos is coming up in a few weeks. You and I spoke there last year, and at the time you said economists' GDP estimates back then, 0.8% for the third quarter, some 2% for the fourth quarter, were overly optimistic. And as it turned out, or at least we haven't got those fourth quarter numbers yet, but it does appear as though they're likely to be a bit better than people were seeing way back then, almost a year ago. So what is it that you've seen then that may change the way that you're looking at 2010? Because you sound pessimistic now, you were pessimistic then. Things turned out better than you expected.
Yeah, I think that's fair, Eric. I mean, policymakers are to be congratulated for throwing everything they had and then some things they didn't have at the system. They've been more successful in putting in a bottom to the global economy than I anticipated a year ago. But look, putting in a bottom does not guarantee the character of the subsequent recovery. We're seeing a big inventory-related rebound right now. These things are temporary. And ultimately, when the inventory bounce runs its course, and they always do, then you've got to look at the state of underlying demand in the global economy, and it's not going to be strong. So I congratulate the policymakers for doing creative and extraordinary things, but I would hate to forecast the future based on their success in putting in a bottom.
And yet, Stephen, you still express doubts. Even though they have put together some policies that have worked, you still express doubts about whether or not they can actually pull back those policies.
Look, we've seen the most extraordinary monetary stimulus on record in the 15 or 16 months post Lehman Brothers. If these guys are going to deliver on these exit strategies that they continue to be so emphatic about, that means that we will then have to see the most extraordinary withdrawal of stimulus on record. And how is the world going to do withdrawing this extraordinary stimulus?
So is now the wrong time, effectively, to end quantitative easing, to end the purchase of mortgage-backed securities?
Look, there's never an easy time to do it. But the longer they wait, and this was exactly the problem that Greenspan and his accomplice Ben Bernanke created post-equity bubble, the longer they wait, the greater the chance they sow the seeds for the next bubble and destabilizing set of imbalances. So I'm in favor of an early exit strategy, albeit that does introduce some risks into the equation. But if this recovery is as strong as Bernanke and the markets think it is, then the time to exit is now.
Okay, Stephen, thank you so much for joining us.